I do think that having a high credit score is important. If you are someone in your 20s, that's when you are most likely going to be looking for your first home. And if you don't have a good credit score, then you won't get a good mortgage. And then lack of financial education. So this is something that I don't think it's necessarily the 20-year-old's fault. I think it's more of the education system's fault because they don't teach any sort of financial literacy. I do believe it is changing. There's been more schools that are requiring a finance class that students need to take in high school, but it's still in its beginning stages and not all schools have this requirement. So I honestly think that it's not really the 20-year-old's fault for not knowing this, but this is a mistake that a lot of them make. Because of this, they are unable to make any sort of informed decisions, which lead to costly mistakes. Now, the other part of the lack of financial education is not seeking advice. So if they don't understand something, they don't reach out to a professional who can help them learn more about managing their money. They instead just avoid it altogether, which I think more has to do with being young and naive and not really realizing the impact of money management and wealth later on. The next mistake 20-year-olds make is ignoring any sort of investment opportunities. So many 20-year-olds avoid any sort of investing due to lack of knowledge or a fear of risk. They don't realize the benefits that could come from investing. They want to keep their money in a savings account or a checkings account so that they have control of it and they know that it is there. They don't realize the potential gains that they're missing out on and that inflation is slowly eating away at the money that they do have. The other thing is that they don't diversify. So again, this falls into the checking and savings account. They have all their money in cash. And so because of this lack of diversity in their portfolios, this increases their risk and reduces their chances of actually having a good return on their money. The next thing is they neglect any sort of insurance. So there's insufficient insurance coverage for people in their 20s. They skip insurance mainly so that they could save money, and this could lead to significant financial loss like any sort of health issues, car accidents, or theft. Just because you are younger and have more energy does not mean that you are immune to diseases or life-threatening incidents like a car accident. That could happen, and having that insurance will help significantly. If you are in your 20s, try to avoid this mistake and get insurance coverage. The next mistake 20-year-olds make, which is related to the student loans, is that they mismanage those loans by ignoring any sort of loan repayment plans. Now, there are different kinds of payment plans that are offered when students graduate college and they start working. However, if they ignore these plans or they decide not to pay any sort of money, then the payments are just going to be higher, and so is the interest rates. And this will just hurt them in the long run because student loans cannot be forgiven if they file for bankruptcy. It will always be there for the rest of their life. And the other thing that 20-year-olds do with the student loans is that they rely on deferment and forbearance.